Welcome to the Lend Academy podcast, episode number 123. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It. Today's podcast is sponsored by Fundrise. Fundrise investors earned over 10.8% average annualized returns during the second quarter of 2017. That's approximately 50% higher than a typical diversified peer-to-peer lending portfolio. How? Fundrise is the first investment service that makes the benefits of private market real estate investing available to everyone online. You can begin with as little as $500. Go to www.fundrise.com/lendacademy to find out more. Today on the show, I'm delighted to welcome Rory Eakin. He is the co-founder and COO of CircleUp. So CircleUp are an online marketplace. They are focused on equity investing, and although we will get to another product offering in this show, they're focused on one category, the consumer goods category, and they have built up a business with tremendous knowledge, tremendous data on this category. It's very impressive to me what they've done as far as accessing data based on this one category. We talk quite a lot about that. We talk about how they do due diligence and how they're using this data to underwrite these companies. And we also talk about their debt offering, which they now offer loans, a product they launched earlier in 2017. So we talk about that in some depth as well. It was a fascinating interview. I hope you enjoy the show. Welcome to the podcast, Rory.
Glad to be here.
Okay, so let's get started and give the listeners a little bit of background about yourself. Tell us what you did before you started CircleUp.
Sure. Yeah, I have a somewhat circuitous route to this work. After college, I actually went to Cape Town, South Africa for several years and taught a math class at the University of Cape Town. It was an interesting and early formative experience in my career for several years before coming out to California for my MBA and a couple of years at Boston Consulting Group before having an investing role with a family office entity of Pam and Piero Midyar. So the founder of eBay, Piero Midyar, and his wife set up a number of different entities. And for about 4 years, my role was investing in marketplaces and market-driven mechanisms that were seeking to improve the world. You know, they were really focused at the time around thinking about ways technology could make the world a better place. It was the early days of the concept of impact investing. So thinking about social impact and benefits for society as well as investment returns. It was a fascinating and challenging role that really opened my eyes to the power of technology to improve outcomes around the world and create more efficiency. And so I was doing that globally for about 4 years when my co-founder Ryan and I started thinking about the idea here in the U.S. and applying technology to a big part of the U.S. economy that just wasn't working as efficiently as possible.
Right. Well, that makes more sense. So I think I can confidently say you're the first person that I've had here on the podcast who was a teacher in South Africa. So that is a circuitous route. I mean, the Midyar, that's obviously not that unusual, but boy, what led you to go down there?
Well, it was a fascinating fork. You know, you think back to your career and the different moments over time, but I was graduating from university at the time and had done an internship in investment banking and had an offer to return to that path and sort of go a more traditional route of a couple of years in investment banking and then thinking, MBA graduate school after that. And there was this fellowship opportunity, a program through my college that gave us a chance to teach in the classroom in Cape Town. It was something I couldn't miss. And I thought it was a good opportunity to broaden my horizon and challenge myself in a new way.
Sure.
And I still look back at those days as a time that I really grew and challenged in a completely different. The skill sets I'd pull on from that, I think, served me better than an analyst program at an investment bank at this point in my career.
Right. Makes sense. So anyway, let's move forward to CircleUp. You guys have actually been around for quite a long time. What was the impetus behind doing this, and what problem were you trying to solve?
It was the intersection of our two backgrounds. My co-founder Ryan Kalbeck and I was kind of coming out of that world, thinking about applying technology to large markets and the ways you can move industries and problem sets from analog to digital. Ryan had spent his career in middle market private equity, focused on the consumer goods sector in the U.S. So think packaged goods, products, food, beverage, personal care, and was seeing a massive secular shift. Small brands taking share from big brands. When we were looking across the economy, and this was now 2012, and seeing so many small companies growing so quickly, but no system of support for those businesses. Unlike technology, there was no Silicon Valley. You had companies spread all across the country who were looking for capital and no pathway for them to raise capital. And so it was a tie-in between those two backgrounds, where a marketplace at that time came to us as a potential solution. We were looking for something that would apply technology to improve the lives of entrepreneurs and investors. You use technology to lower the costs on both sides, both to find the right partner, whether from an investor to a company or company to investor, and to do it in an information-rich and a data-rich environment. You can get much more efficient for both pathways.
So did you sort of go out with the intention of tackling like the consumer goods category, or did this just sort of evolve over time?
That was from day one. And it is much to the consternation of a lot of the investors we were talking to at the time. We were as we looked to raise capital, everyone was saying, well, why not tech? There's such a focus on early stage tech investing, especially out here in Silicon Valley. We were in San Francisco at the time, and in my view, very myopic view, that the only place for early stage investing was tech. I think that's changed dramatically in the last 5 years, in part because of CircleUp, but from a wider recognition of how much these other industries can see great growth from early stage companies. But we saw a massive industry in consumer and a problem to be solved. Even then and still today, there's so much capital looking for early stage companies, and there's so much of a tech echo chamber for small businesses, for tech companies to find those investors and for investors to find. I didn't see as much of a pain point and much of a big opportunity to solve. And of course, later, and I think somebody talked about, consumers led itself very well because of the data availability in consumer. It's enabled us to do things that I don't think would be possible in the tech industry. But consumer was the focus from day one.
Right. That's interesting because, it's funny, in a previous life, I actually ran a digital label printing company, and most of my customers were in the consumer goods category. And it's a category I got to know well. And it's funny because I know raising capital was perennially challenging for these companies. And we would actually be a somewhat quasi capital provider by extending out our terms for 90 or 120 days because they just they had a cash crunch, and they found it. There wasn't a company like CircleUp back then, and this is in the early 2000s, and it's been a perennial challenge, I think. So anyway, can you give us then just some examples of companies that have successfully raised capital on CircleUp?
Sure. We work across the consumer spectrum: food and beverage, personal care, pet, baby. So some companies that have worked with us include Halo Top Ice Cream. So as a very small brand at the time, it's now the number one pint seller in the U.S. in the ice cream category. It's going very, very well. A type of innovative brand. They had a different lens on the ice cream category back 4 years ago and found support on the platform to grow that. Back to the Roots, which is another food company that has done very well and has a very incorporated social mission. Smarty Pants Vitamins is in the vitamin category, a company that creates a gummy vitamin and has some intellectual property and really compelling brand around that. So these are the types of brands we see. Companies typically with $1 to $10 million in revenue. They have some traction in the marketplace, but they're looking to accelerate that growth.
So then how do you obviously you've got a range of different companies inside the consumer goods category, and I imagine you've got a pretty efficient due diligence process, but I'd like to because I imagine people come to you and you should see, oh my goodness, there's no way we're lending money to that company, and there are others that it's touch and go. So what's your filtering process, and how do you go about deciding whether a company is worthy of your platform?
So it's been an evolving process, like any business. What was initially in the early days more manual. We had a team of experienced private equity investors and investment bankers that were looking at companies on a one-off basis and evaluating them based on their own training and a committee and a process to approve that. Typical diligence at that time. So you talk with the management team, you look through the financials and the projections. We, from day one, have been a registered broker-dealer, so we also have compliance and suitability requirements that we conform to as well, to make sure we understand the offering and the background of the team and make sure it's suitable for the investors on our platform. We work only with accredited investors, so there's certain standards that we have to conform to there as well. But what's been really powerful over time is using data and machine learning to try and make that process more efficient. We've built some core technology that we overall brand Helio, a set of internal data and algorithms that are helping us look not only at the applications when they come in, but across the entire consumer sector on a regular basis, evaluating brands even before they apply to CircleUp around a number of dimensions that we believe are powerful of predictors of future success. And that's really the starting point for us today, and allows us to be, we believe, a lot more scalable, a lot more accurate over time in working with the types of businesses that we believe have the potential to outperform.
Okay, so is that your do you still do human review, or do you rely on your? You do. Okay, so is the machine learning like a first cut? Is it?
It's both a first cut and something that we work on throughout the process. So it's not just a filtering mechanism at the top of the funnel, but something that our business teams are engaged with throughout the process.
Okay, that makes sense. So I remember when we chatted a year or two ago, and I remember you said at the time that you're also tracking all of the companies that you reject for funding. And I mean, so what have you learned there? And have you incorporated that information into your due diligence?
We have, and that's become one of the powerful sources of that data. It's expanded even beyond that now, where it's not just the companies that are applying to us, but a foundational leap for us was making the move from beyond just the companies that we were looking at, but to map the broader industry. So we are today tracking over 1.2 million companies in the consumer sector. And maybe just take a step back and reflect on that. An amazing part about the consumer industry relative to other categories is the availability of information about the brands. If you want to, you can look up any company in the U.S., if you know the name of the company, and find out a whole host of information about them, where they're sold, what the price point is, what SKUs are available, what customers think of those products. All of that information is publicly available. But aggregating all of that and making sense of it and normalizing it, so you're looking across different information sources and tying it back to a single company, and then having that core data from our marketplace over time of what's successful and what's not, and that goes to your question around the application data, that gives us the ability to have ground truth, training data. So we take our training data about the companies and how they're performing from our marketplace, but are now applying it not only to the companies that have applied or have applied and rejected that we're able to track on an ongoing basis, but to the universe of companies at large. And that becomes a much more powerful tool for us in evaluating any given brand. Because like any investor, the challenge you have is not only yes or no to a given company, but ideally, how does this company situate within its universe? Mm-hmm. If we're evaluating a popcorn company, you don't want to only make that decision, do I want to work with this popcorn company or not? You want to say, well, can I look across the 800 popcorn companies that are available in North America, and which one of those would I want to work with? And then be more proactive in your outreach, not passive, and seeing what company you'd want to partner with.
That's fascinating. Fascinating. So, I mean, are you working with vendors? Is this something you've built yourself? Like, because I imagine just going out and scouring the web, with all of this information, it's not a trivial engineering task. So, have you built this in-house, or are you using outside vendors?
It's all internal. This is a core IP part of what we've done, and I think is a very big part of the CircleUp story. We, as you noted, have been around 5 years. We've been very successful from a fundraising perspective to be able to raise a significant amount of capital to build a wonderful team that is highly talented and have built this core product all internally.
Mm-hmm. Wow, that's impressive. So the companies that typically get funded are these, and I say these are not really, I mean, there's not many venture backable companies, I imagine, in this space. So, I mean, is this, like, what is the size of the round that they're typically doing? And is this really a seed round? Are they looking at this for working capital? Can you just tell us a bit about the fundraising that the companies are doing?
Sure. It's on the equity side, and that's where the marketplace has been over the last 5 years. Traditionally, it's growth equity, so typically $1 to $5 million rounds. You say not traditional venture backed, but we see a lot of private equity firms, lower middle market private equity firms, and family offices active in the space. So the typical transaction for us is a family office, perhaps outside of that geography, or somebody that wouldn't otherwise be connected to this brand, who meets the company through our process and conducts their own due diligence, of course, in addition to information presented through the platform, and then ultimately writes a check on their side anywhere from $250 to $2 million. So the overall rounds are $1 to $5 million, and you have a small number of investors typically. But that gives us the information about the brand themselves. So the companies we typically work with already have about $1 million in revenue, allowing us to do that work I was alluding to from the data science side about their performance and how they compare to others in the category.
Right. Okay. So then, given that you've been around for a while, and I imagine there's been some exits. You see deals all the time of food companies being bought, it seems, and other consumer goods companies by some of the big players in the space who are looking for these niche brands. So can you tell us a little bit about the numbers, like how many deals you've done, how many exits, how many failures actually would be useful as well?
Yeah. So the first caveat is we don't have perfect information on the companies. As the marketplace, we connect to investors, but we don't typically become shareholders in the businesses themselves. So I'll update where we are today, but with all of our businesses, we aren't able to understand future financings with full clarity and exits around that. But 250 companies have raised on the platform. And from what we see and the visibility we have, we're quite pleased with the aggregate results. It is still a high-risk, illiquid asset class. So no exits yet, but the companies that have grown, we have a number of companies that have grown quite substantially. So we know of at least 10 companies that are no longer operating out of those 250. So it's a very small percentage today. There are likely to be more already and more in the future. It remains a high-risk, illiquid asset class for us. But in aggregate, we believe the investors in our portfolio overall across the marketplace will do well over time.
So you said you're tracking these companies. Yep. You can obviously track to some extent their growth. Do you have some stats on how the companies that you've funded are growing, particularly like versus the average in the space? That'd be interesting.
Yes, that's one thing we have been able to do. So the companies that raise versus not, and the last time we looked through that data, there was significant outperformance, in part because they raised capital successfully, right? So when you have additional capital, you're able to grow. But the aggregate revenue CAGR for companies on the platform was over 30%, meaning they were growing their revenue from the time that they had raised on the platform more than 30% per year annually through to today. So where we are still building out our full information set on the financings and potential exits, revenue being one of the key drivers of growth, where it gives us the understanding that the companies themselves are growing growing quite nicely as a portfolio overall. There's still variability, of course, in that. The companies that grow 100x in some extreme cases in revenue from the time that they've raised capital to companies that aren't performing as well. But across that portfolio, to have a 30% average annual revenue growth, we think is quite where we want to be.
Mm-hmm. And so, what about the investors that are investing on your platform? Are these typically just high net worth individuals? Are you working with some institutional funds now as well? Who's investing?
We have a mix of both. I know a number of the marketplace lenders do as well. So the average investment on the platform now is about $200,000. So it is more oriented towards family offices and what you would call quasi-institutional investors. We do have a series of funds that we have raised as well. So there's the marketplace where there's individual security selection. An investor can come identify a company and make a direct investment into a company. And then our funds where investors can get diversification through a fund that we manage. The preeminent example on that is a $22 million fund that has institutional investors looking for allocation to the asset class overall. So that we helped build a portfolio that's diversified within the companies that are raising on the marketplace.
Mm-hmm. Mm-hmm. Okay, so I want to switch gears a little bit and talk about your debt product that you launched, I think it was earlier this year. Is this something that was driven by the consumer companies, or is this something that you just felt like was a natural extension?
No, it was what we were seeing day to day. There's so many companies were struggling with the credit options in the market, and both us not having the ability to work with them on an equity side, given what we were seeing a potential forecast. There's just so much you need to believe for a business to underwrite it for equity in terms of the future state versus on a credit, which is a much shorter term financial product and one that's backed by obviously credit versus equity as well. So we were seeing companies facing the cash crunch that you alluded to earlier, retailers paying 30, 60, even 90 days after they get the product. And the irony was the faster the companies were growing, the bigger the challenge they have.
Right.
As next month's shipment gets bigger and bigger, if customers are loving the product, they face greater cash needs. And as an entrepreneur, you're faced with either raising a big equity round and taking that dilution at today's valuation, or trying to build a couple more of those cycles where you're able to have better performance numbers and take on less equity potentially, or at least equity at a higher valuation.
Right.
So we tailored a product towards this market where it's a working capital credit line. We're trying to fill that void in the market today, relatively more affordable rates and clean terms in our view, and disclose, and we can talk through that with the customers, but help them when their product is moving on the shelf, build more product and increase the velocity of that growth without having to take on the equity dilution.
Right. Yeah, that's what I used to see when I ran my label printing company. We'd have these companies that were selling into Whole Foods or some other pretty established company, and that's when you feel like, well, it's a pretty good bet that they're going to pay, and but they still needed the capital. So I know it's a perennial problem. So what terms then are you offering? Are these, what's the typical loan size, the duration, the interest rate? What are the averages there?
So the target company is roughly the same. So these are companies with $1 to $10 million in revenue. They're typically EBITDA negative. And that's where we saw there wasn't a lot of great options for the companies in the market. The others in the space either would be very high interest rates on a merchant cash advance basis, or a decline from a term loan or some of the other bigger loan products.
Mm-hmm.
So we've built our product to provide ranges of $25,000 to $750,000. And so the average loan for us is today about $150,000, $200,000. The interest rates are 6 to 15%, but all in APRs in the 14 to 20%. So we feel that the product is quite competitively priced, given the profile of the businesses. And we're trying to move that down further over time. It's something that go ahead.
So as I say, are these secured loans? Because I mean, one of the things that's different about these kinds of companies is that they actually have hard assets. I mean, are you backing these loans with assets or receivables or something like that?
Yeah, it started with receivables. We're underwriting to receivables and purchase orders. So it is backed by the assets. There's a UCC one lien position.
Right. Okay. So then, like I read when I saw your announcement that it was CIM, Community Investment Management.
Yeah.
A company that we know very well. We've had Jacob Haar on the podcast here.
I saw it as one of my ways to get to know Jacob was through your podcast, Peter.
Well, that's good to hear. So they're funding, I believe, all the initial loans. But are you intending to opening this up for other investors, like for your existing equity investors that are on your platform?
Potentially over time. We're still in the pilot phase now. This is an early program for us, and CIM have been terrific in terms of helping us structure the loan and providing sufficient capital to get this business off the ground. Over time, it's an interesting product for us because it provides a much shorter duration. You think back to the questions we were talking about in the marketplace business. We are 5 years in without clean exits on the equity side, despite what we think is tremendous progress in understanding this consumer market and markers indicating what could be long-term future success of the equity investments that have already been made and will continue to be made. But having this loan product allowing for a much quicker cash cycle for our own investors is something that we're going to explore over time. But for now, CIM has been terrific, and we're focused on getting the product right. We're in that phase where there's a lot more iterations in terms of how we're talking to our customers about this product and how we're structuring it. And so it's not quite ready yet to broaden the investor side of that equation.
So are you out there marketing this product actively, or are you just sort of passively marketing it to people who come to you?
A bit in between. It's companies that are coming on the marketplace. It's not fully on the website yet, but we've certainly announced the product and have early companies that are active with us that have been in the marketplace before or that we knew quite well. And it's slowly expanding beyond that. So we've just passed about 100 loans. So it's still relatively early.
Right. So, Andy, do you see this? Like, obviously, there's in the marketplace lending space, there's plenty of competition. You've got Funding Circle, just also another Bay Area company that are offering it. The Lending Club are offering it. There's many other competitors. Are you seeing this as are you trying to build this up and compete against those guys, or is this something that really you feel like because you're vertically focused on the consumer goods category that you're going to stay there?
That's right. It's the vertical focus that for the why this makes sense. I was in conceiving and developing this product with a team, hyper aware of that market. There's some fantastic companies out there that have built great businesses in the small business lending space, online and offline. Mm-hmm. And so you always have to ask yourself, why us and where's this need? But as we look through the data and talk to our customers, we did not see anybody out there that was offering a similar product to be able to have a couple $100,000 on a loan product that didn't have usurious interest rate on the product, that could work with you as you were growing your business, grow alongside your business. But before you were profitable, before you perhaps had been operating for 2, 3, 4 years, where a lot of the traditional lenders would look for that history in an operating business.
Right.
We saw and we continue to see a very big market within that target demographic, and using our data analytics from Helio, being able to both serve those customers more efficiently and improve our underwriting process, we think lends itself well to a business that we're uniquely suited to develop.
Yeah, that makes sense, because most lenders, or many lenders anyway, they get nervous about lending to companies with negative EBITDA. So I can see, but if you've got all this data on the companies, then it gives you have a big advantage there, because you can see what the real risk is, where some of the other companies won't be able to have the same sort of data that you guys have. So we're almost out of time, but I just wanted to give the listeners a little bit of an idea about where you're taking this company. Are you just going to grow your two kind of products that you've got now, or what's the future hold for CircleUp?
Data as a tool. We think a lot about our central mission, which hasn't changed, is helping entrepreneurs thrive. So how can we orient towards providing financial products and resources to help those businesses that may have historically been overlooked or underserved by financial markets? That's really at the core of what we're doing. And Helio is a pathway to do that at lower cost. We have an internal framework here that is not actually ours. It came from a piece of Gartner research that I just love, though. It talks about how you can move up a learning curve by utilizing data. So you can think about sort of the descriptive qualities of data. You can tell a story about what happened, as a first stage. And there are a number of data partners to say, X company sold Y units last year. And that's a very descriptive use of data. But the next phase being a diagnostic. Well, why did it happen? If a company went from $2 million in revenue to $4 million in revenue, is there something you could say about explaining that difference over time? That's a little more technically challenging. You need better data and better insights to do that. But a third phase would then be, well, what will happen? That's where we think we are in Helio today, is seeking to answer that question. It's 4 million today. What will next year look like? Is there pathways we can see to how their receivables will grow, for example, in the case of their credit product, or their top line revenue will grow? Can we map out different pathways their distribution might increase based on looking at enough comparable companies across the sector where we can predict what's going to go? And then ultimately, and this is where we want to go with the company, is how can we help make it happen for the entrepreneurs? How can we be partners to these businesses and provide at scale, quantitatively supported advice and support to these brands? So when you raise capital from CircleUp, whether it's on the debt or equity side, you're also bringing on a partner that has an unparalleled data resource that can help you be successful. So when you're going to that new retailer or distributor, you're armed with a packet of information describing how your brand is differentiated in the market. Or if you're thinking about a new product line, new SKU development, you've got a thought partner that has a rich data set that can answer fundamental questions about when, how, and why you might want to introduce that category. We think those are questions that can be answered in part through data, and building out Helio is a pathway to provide that more and more value to the entrepreneurs through these products. So that's the journey we're on.
Right, that's fascinating. My mind was ticking over when you were talking about that. There's just so many possibilities there, and the value that some of these companies would take. I think basically the data that you have is going to be so valuable. I see even today, and I imagine it's just going to keep getting better. So anyway, we'll have to leave it there. I really appreciate you coming on the show today, Rory.
Well, thanks so much, Peter. Appreciate it.
Okay, see ya. One of the things I love about this industry, the fintech industry broadly, is this use of data, that many companies are out there doing things that have never been done before, gathering in data sources that have never been used before, and sort of compiling this in such a way to give a much clearer picture of a particular company or an individual. And the stuff that CircleUp are doing around data is truly fascinating. And they're building themselves a very wide moat in their business, because this use of data and this creation of not just the analysis tools, but the sort of the data gathering, it's not a trivial task, and it's something that any company, big or small, would find difficult to duplicate. So I think what CircleUp are doing there is going to position them very well for the future in providing their core category with additional value. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's podcast was sponsored by Fundrise. Fundrise is the first private market real estate investment platform available to everyone. That is, accredited and non-accredited investors. I've been investing myself since 2015, And we had the CEO of Fundrise, Ben Miller, on the podcast back in episode 110. You can begin with as little as $500. Go to www.fundrise.com/lendacademy to find out more.